Well, hello and welcome to today's webinar, AAII Expert Roundtable, using AAII's premium services to navigate 2022 and beyond, led by our financial analysts, John Bachkowski, Wayne Thorpe, Charles Roplett, Derek Hagman, and Matt Markowski. So yeah, thank you so much for joining us this afternoon. We are happy to have you all here. And my name is Jenna Brashear, and I'll be your host for today. I do want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And a handout of the presentation is available under the handout section of your GoToWebinar control panel, which is located on the right-hand side of the screen. And if you have any questions for our speaker during this presentation, please submit them using the questions section of your GoToWebinar control panel. And our moderator for today, John Bachkowski, will select questions submitted and read them aloud for the benefit of all watching the broadcast. Any questions that are not selected for the broadcast will be reviewed and addressed afterwards. And if you experience any issues with the audio or the video of the webinar, please consult the instructions on how to change your device's settings or consult the GoToWebinar website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this presentation's handouts, and then also any resources that we discuss. And for our new viewers, we just like to give a little bit background about our organization. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And with that, I'd like to hand over the presentation to John.
Well, thank you very much, Jenna. It's a pleasure to be part of this roundtable. And our focus today is on how to use AAII premium services to navigate 2022 and beyond. And I've been with the association now for 35 years. And I think if there's a mistake to have been made when it comes to investing, I've certainly made it. And, you know, what's important, though, is that we learn from our mistakes. I think, you know, Warren Buffett said it best that investing is simple but not easy. And I think the way you make it easy and simple is by having a disciplined approach. That's the key to being a successful individual investor. As humans, we have certain behavioral biases that really help us survive in the wild, but really doesn't help us survive the financial jungle. We typically respond very emotionally to market volatility. We chase short-term performance that typically impacts what kind of funds we seek out, what kind of stocks we seek out. As humans, we fear losses much more than we actually appreciate the gains, and that tends to make us perhaps sell our winners quickly and hold on to our losses much too long. And as even as stock investors or stock pickers, studies have shown that more and more we tend to pick lottery stocks. We don't necessarily put together a well-diversified portfolio that's thought through. We tend to try to find some potential high-flying stocks that will make us do well. And no matter how long we've been at it or how short we've been at it, we tend to be overconfident of our abilities and kind of fall in love with what we've done. We kind of don't want to prove ourselves as being wrong. And really the best way to overcome all of these behavioral biases is to have a disciplined investment approach. And our focus today is to introduce you to a number of different disciplines that we use here at the association to teach you how to put together portfolios. And as an investor, I think the best way to have long-term success is to diversify your holdings, diversify by style, by size, by asset class, industry, keep your costs low. And on top of that, you know, when I joined the association, I was kind of surprised that there is no one specific investing style or investing approach that we talk about. And really what it's come down to is that what we found is that there are many successful approaches, but it's important to have a disciplined approach to it. And our focus today is to talk about some of these approaches. In fact, what we found over time is that there are a lot of different ways to pick successful stocks, to pick together good portfolios. And perhaps you've heard about things such as smart beta, factor investing, things like that. And our editor, Charles Roplett, is really the man behind the VMQ approach. And he's the person here that will put together this educational approach that puts together a stock portfolio that focuses on these factors. Charles, why don't you give us a little bit of background about yourself and about the VMQ approach?
Sure. Thanks everybody for joining us this afternoon. As John said, the VMQ approach stands for value, momentum, and quality, and it is based on factors. And so For those of you not familiar with factors, a simple way to think about it is the trait of a stock that's associated with higher returns. And traditionally, the way you get a higher return for a stock is taking on more risk. So if the company itself, the business has greater risk, you should demand a higher return for compensation for taking on that risk. But what the academics found out that if you look at certain characteristics in stocks, there's excess returns beyond what you would expect once you factor in risk, and those are factors. Among the factors you see in front of you is value. And value basically means what stock is cheaply priced relative to its fundamentals versus what is expensively priced relative to its fundamentals. So many of you already use this. You might look at price to book, the share price versus book value per share, price earnings, very popular PE ratio, price to cash flow. And what the data shows is it really doesn't matter which valuation ratio you use. Cheaper beats more expensive. And they tend in the world of factors to describe it as value versus growth. So growth tends to be highly valued stocks, not necessarily stocks that are growing earnings highly, but stocks that have high valuations. And what you can see here is that across the board, when we look since 1952, so a large amount of data here, we see value beating growth. And some people might say, well, that's going back to 1952. That's a long period of time. As John said, we tend to be evidence-based investors. And I personally I like to call myself an odds-based investor. I can't tell you what exactly is going to happen over the next 5 years, and neither can anybody else. But I do know historically that buying cheaper valuations has resulted in higher outperformance than buying high valuations. So this is one of the cornerstones we use in VMQ. The other thing we use is momentum. And momentum basically, we can get the slide changed. Thank you. And so momentum basically uses relative price strength rank. A lot of words here. In very simple terms, stocks that have outperformed, have done better than the average stock, tend to continue outperforming. And it's very simple. Investors like winners. Investors like stocks that are doing better. When you try on CNBC, what do you hear about? You constantly hear about what stock is doing really well right now. That's really the heart of momentum. They found out that stocks that have done well in the past continue to do well. Now, stocks don't continue to do well, continue to have above average returns, excuse me, continue to have above average returns for a really extended period of time, but they do continue to experience periods of outperformance. And what you can see here, it doesn't matter if we're looking at large cap stocks or small cap stocks, winners, stocks that have outperformed, tend to continue to outperform for a period of time. Let's go to the next slide. And so you might think that, well, value and momentum are very different characteristics of stocks, and they are, but because they're different, they pair really well together. So what you see in front of you, this is a chart from S&P. You can actually find this on S&P website. Just type in S&P Factor Dashboard. And this actually looks at the S&P 500 and different subset indexes. For instance, the dividend aristocrats, buybacks. You see there in green something called QVM top 90%. It's basically their deep value stocks in the S&P 500, and then we're taking those subset of those value stocks and identifying the ones that have the best quality to Q and the best momentum. And what you can see here, the green box relative to the purple boxes, over the last 15 years, combining quality of momentum and value has given you higher returns for less risk than going with a straight value approach. So there's an advantage to doing this. Momentum and value pair really well. But the problem is when you just say, okay, give me cheap value and give me strong momentum, you still end up with a large number of stocks. And so this is why with VMQ, we like to actually incorporate quality as well. Can we change the slide? And actually, let's go to one more. And so for VMQ, and also I will say in our A+ investor service, we use the same value grades, we use the same momentum grades, we use the same quality grades. And quality is in the eye of beholders. Well, one man's gem is another person's junk. And so if you look across the board for definitions of quality, they vary, but we actually did a lot of research. We looked at what a lot of other ETFs were using for defining quality. We read a lot of research, and we came up with 8 characteristics to measure quality. And as you can see here, it really comes down to some pretty simple things. Are they using assets efficiently? Are they profitable? Are they reducing the share count? Do they have a low risk of bankruptcy? Those types of things are all associated with strong fundamental strength. And I think they're traits that a lot of people can say, yeah, if I want to buy a company, I want a company where the CEO's making money off of the assets, the company's making a good profitability, and by the way, I don't have to worry about it being too much in debt. And so we look at those traits and we rank stocks across all 8 traits. Now, occasionally, you might have a stock that may not have every single trait because of its financial structure, because of the business environment. So we don't require them to pass on all 8 traits, but we do look at stocks across all these factors, compare them to how all other stocks compare these factors to really find the stocks that are fundamentally strong. So VMQ, we're really looking for below average valuation, above average momentum, and really stronger than average quality. And we combine those 3 traits into a single strategy. Go to the next slide. And so we combine this into our portfolio, which is our VMQ stocks, and you can find it on our website. Please go to the next slide. And so our portfolio, we found this portfolio in 2018. Unfortunately, our timing wasn't so great because there was a correction soon after we launched the portfolio. And then within 2 years of launching the portfolio, we did have a bear market. So timing wise, obviously wasn't great, but the portfolio since the bear market has done very well versus our benchmark, the IYY. This is a 20 stock portfolio, and I'm very agnostic when it comes to market capitalizations. We have companies with market caps as small as $95 million. So we're really doing the small cap and taking full advantage of the research into factors. But the other end, we own companies like Target, which has a market cap of over $100 billion. So one of the advantages about factors that we individual investors have that the professional investors don't have is we can take full advantage of factors by going up and down the market capitalization scale. And that's what we do with VMQ. We are more volatile because we are seeking higher returns. But our turnover, even though we include momentum, our turnover over the last 12 months has just been 10%. In fact, we recently made 2 changes to the VMQ portfolio. Those were the first 2 transactions we made in the portfolio in a span of over 6 months. So even though there is momentum, this is not a trading strategy. This is a long-term investing strategy based on characteristics that have been shown to lead to outperformance over the long term. Now let's go to the next slide. John, back to you.
Well, thank you. Thank you very much, Charles. So, you know, what Charles, I think, has shown us is that a disciplined approach is key to putting together a portfolio, doing buys and sells. One thing, though, that's interesting is that, you know, I've been at the association, as I said, for 35 years. I've noticed there are certain, you know, gurus, stock superstars that have also used a disciplined approach. And it could be varied. It could be in the value approach, it could be growth approach, to actually put together portfolios and come up with those rules you can actually follow and make use of. And out of that really came an approach called the Stock Superstars Report. And Matt Markowski, one of our rising stars here at the association, has recently taken over as lead analyst for the Stock Superstars approach. Matt, why don't you give us a little bit of background on the approach behind the Stock Superstars approach and how one can make use of it?
Thanks, John, for your introduction. The Stock Superstars Report portfolio is to provide a diversified investment strategy that's based on our well-known investing superstars, so to speak, from the past. Each of our 4 strategies within the SSR portfolio were developed using the ideologies of these famous investors. The ultimate goal of SSR is to provide a complete portfolio that is protected against changes in market conditions. Now, these strategies are vastly different in their approach to selecting winning stocks, with some being much riskier than others. Ideally, you can choose a strategy that aligns more with your personal investment goals, or you can invest in the SSR portfolio as a whole for its benefits that it has for diversification against the changing market. Of our 4 groups, our first group portfolio is based on William O'Neill's strategy of our accelerating earnings growth and price performance that we use technical analysis for. This strategy is typically more exposed to the market as it aims to capture short-term price increases as a result of higher volatility. We've seen a lot of that in the past year or two. And our second group is home to David Drummond's investment strategy. He was known for going against the market's expectations for a stock by investing in undervalued, low price to earnings stocks with potential for significant earnings surprises. Our third group uses James O'Shaughnessy's composite scoring strategy. It's a factor-based strategy that measures a company's value, financial strength, and earnings quality through a series of fundamental data. The fourth and final group portfolio holds John Neff's strategy of high-value companies with potential for fundamental growth. I'll be featuring the Group 4 Neff strategy today with a company that currently passes our initial screen. The primary measure for our Neff strategy is the dividend-adjusted price-to-earnings growth, or PEG ratio. It's a measure of the market's expectation of the company value compared to its expected growth through earnings per share. The strategy also relies on company fundamentals like sales growth, cash flow, and operating margins that are greater than their respective industry averages. The Neff strategy is currently the best performing portfolio within our SSR whole portfolio, with an average annual return of nearly 12% since its inception 20 years ago. The SSR portfolio is interesting in the fact that there's so many different strategies that grow and not grow as much, but the key proponent of it is that there is a diversification of not only companies within their respective industries or diversification of industries, but the strategy itself is so much different across each of our 4 portfolios. And I think that the most important factor of SSR is the way that these strategies work together to create a complete portfolio. That's ideally what we're aiming for here. Thanks,
Thank you, Matt. Did you have any other observations for us to make?
All I can say is our Group 1 portfolio has been a little shaky the past few weeks, but we're seeing market turnaround now. And ever since I've been taking over the portfolio in the past month, I plan to keep watching that and making more additions and making sure that we're on the right track.
Makes a lot of sense. I mean, Group 1 obviously is a can-slim growth approach, and probably a little more volatile than the rest as far as volatility. But then I think one of the things I know we've studied over the past is that together, mixing the different portfolios together tends to reduce the overall portfolio. And what I like about the SSR approach now is it's much easier to be able to either pick one approach of the 4 or pick them all together as a group. And again, it shows the importance of having a disciplined approach and how looking at gurus that have had a long track record that have helped quantify how they make their picks allows us as investors to also, in effect, invest like them as well. So if you want to go ahead and learn from the best minds of Wall Street and apply it in a disciplined approach, which is very critical, it's done that way through SSR, and SSR has the buy and sell rules to help you with that. And disciplined investing can be applied in many different ways. And what we found is that we have, in many cases, many of our members have gotten a little bit older, they've reached retirement age, and they're still looking for a disciplined approach to investing, but perhaps looking for a little bit less risk than, say, the can-slim approach that's part of Group 1, perhaps looking for a little bit extra income as well from their portfolio. And that's really where Derek comes in. And Derek is the lead manager of dividend investing. Take it away, Derek.
Yeah, thanks, John. Hopefully we have some dividend investing fans on the webinar today. I certainly am. So I'm just going to touch on dividend paying stocks over the next couple of minutes and just give you a quick background on who I am. Like John said, my name is Derek Hageman. I'm a financial analyst at AAII. I'm also the editor for AAII's dividend investing portfolio. I have roughly 20 years of investing experience. Prior to AAII, I worked as an equity research analyst and as a private equity investor working on transactions across numerous sectors. And before I get into the dividend investing portfolio, I just wanted to give a little background using some data from Ned Davis Research and Hartford Funds, just talking about over long-term holding periods, how dividend paying stocks, they've historically provided higher cumulative returns with lower levels of volatility versus non-dividend paying stocks. And at AAII, we seek to select stocks with a track record of rising dividends that are expected to continue to rise, which historically have greatly outpaced dividend cutters and non-dividend paying stocks. And simply put, in my mind, dividend investing, it's one of the key foundations of successful investing. And this statement, like I just mentioned, it's not only my opinion, it's backed by analysis from Ned Davis Research and Hartford Funds. These firms looked at the stock performance of companies that don't pay a dividend. They also looked at those that cut their dividend, those that left their dividend unchanged, and those that raised their dividend. And as you can see from the performance on your screen, stocks with rising dividends greatly outpace the dividend cutters or non-dividend paying stocks. And further, if you focused on rising dividend stocks over non-dividend paying stocks, you would have increased your investment by an average of almost 5.9% per year over the 48-year study that Ned Davis Research and Hartford Funds did. So in contrast to companies that cut or eliminated their dividends, companies that grew or initiated a dividend have experienced the highest return relative to other stocks since 1973. And this is the important part as well, with significantly less volatility. If we could advance the slide. Great, thanks. I just want to touch on a few of the portfolio characteristics of the DI portfolio. So to achieve a total return that consists of both dividend income and capital appreciation, AAII dividend investing, we focus on 3 pillars when making dividend investment decisions. The 3 pillars of successful dividend investing are growth trends, financial strength, and finally valuation. And there's a bunch of different components that go into each of those. But a company's success, it's driven by its ability to generate sales and convert revenue into earnings and cash flow. Investors need to also understand a company's underlying financials and its ability to generate cash flow, pay its obligations, and return capital to shareholders. And stock prices, they tend to fluctuate between high and low extreme valuation levels, and these relationships can be used to determine a stock's value range. If we could advance to slide 3, please. Great, thank you. Specifically, if I had to sum up the dividend investing strategy, it would be, it's a total return strategy that seeks stocks that have the potential to rise in price and make larger dividend payments in the future. The dividend investing portfolio, it was started in 2012, and it is a model portfolio with real capital investment. The portfolio includes 24 hand-picked dividend-paying growth stocks. Some of the portfolio characteristics include it has a bit of a mid to large cap value tilt. The current portfolio average yield is 2.6% versus its benchmark of 1.1%, which is the IYY. And based on the current portfolio composition, it pays a monthly dividend every month of the year. So you can count on monthly income, which is really important, especially in retirement. And the average annual performance, since everyone asked, since 2012, it's been 12.8%. If we could forward to the next slide, please. One back, maybe. Okay. I was hoping to show just, I had a snapshot of the dividend investing website and some of its features. So if we could just go to the slide with.
One more slide.
Yep. There we go. There it is. That's a snapshot of the DI website and some of the features you can see across the top. If we could advance to the next slide, please. All right. I just wanted to highlight 3 of the key features. So dividend investing and Platinum subscribers, they receive weekly and monthly commentary by me, since I'm the editor of the DI portfolio. And we talked about 3 pillars of successful dividend investing earlier. And one of the features includes a dividend grading system. Very excited about that tool. It grades dividend paying stocks based on the 3 pillars, which are, again, the growth trends, financial strength, and valuation grades. And another great feature that we're excited about is our newest dividend screener tool, which is an interactive tool for finding dividend paying companies. I hope that helps give a brief overview of AAII's dividend investing strategy.
Thank you very much, Derek. That was quite interesting. And I know that all of our analysts will be around for questions as we continue on with this presentation. In fact, Derek's going to come back in a moment and perhaps give us a stock that illustrates how the dividend investing approach can be used to find. One question that's come up, and perhaps
Sure.
If you're in a position to answer it now, someone has asked, what is the IYY?
The IYY is it's the iShares Dow Jones. It's an ETF. It basically represents the S&P 500, and that's the benchmark we use across the all our premium products at
It is a market cap weighted index. I think represents overall all the stocks. So because it is cap weighted, the 500 probably plays a predominant role in its performance.
Sure.
But the members are asking, so it's IYY is just a benchmark that we use, an index we use to compare all of our funds. It's total return based, so we can do apples to apples type comparisons. Derek, I'm always here to try to stump you, and yeah, I can't stump you, man.
I'm easily stumped. Appreciate it.
Pleasure. Actually, we had a member here that was asking, Dilbert was asking, obviously value has had a great run. This is probably directed perhaps more to Wayne, that'll be speaking next. Value has really done well long term, but there are certain transformative growth companies that, also have had a good positive impact as far as performance. And we've been seeing that in this SSR approach, that there are growth approaches that can be done successfully and are very strong on a total return basis. And Wayne, I know you've been cranking up the computers and entering in your various formulas and whatnot. Why don't you tell us a little bit about what you've been working on? And one of the things I guess we're talking about here is the Platinum program itself, the overall service people could subscribe to. And one of the benefits, or one of the things Platinum came about, was because all members wanted to have access to all of these tools that members can have access to. And we wanted to make sure that when we launched Platinum, any new services we develop will be part of it as well. We're talking about newsletter services here. So Wayne, why don't you give us a little bit of genesis about your thought behind putting together a growth-focused approach, and what sets your thought as far as how successful growth investing can be versus just seeking out high-flying stocks that might be crashing back to earth soon.
Good. Thank you very much, John. So hello, everybody. I'm Wayne Thorpe. I'm the head of development for AAII's research and analysis products and services. I've been with AAII now for just over 25 years. I just celebrated my 25th anniversary at the beginning of the month. And as John alluded to, what I'm going to be talking about right now is I'm very excited to talk about a new project that I've been working on for the past few months. And really what this grew out of was, AI's current stable of premium portfolios offers a range of attractive options, mainly to value-oriented investors. Value is a cornerstone of VMQ, with additional considerations for quality and momentum. DI, as Derek just discussed, caters to investors looking for income generation with lower volatility relative to the overall market. And SSR's guru strategies, especially the Dremen, O'Shaughnessy, and Neff approaches, are also steeped in value. And really, right now, only the SSR Group 1 approach, which follows the canceling strategy of William O'Neill, that's really the only AI portfolio that tilts more towards growth. And this methodology looks for strong and consistent earnings growth on both an annual and quarterly basis. But as Matt also talked about, the strategy also follows, has a strong underlying price momentum requirement, and actually whether or not the portfolio itself is actually even adding stocks to the portfolio is driven by the overall direction in the marketplace. So, looking at our current offering of portfolios, but then also, talking to our members, a lot of our members are looking for more options when it comes to growth investing. And so to that end, for the last several months, I've been working on the premise for a new growth letter that we hope to launch in the coming quarters. The appeal of growth stocks is their potential for significant growth. So companies generating strong, prolonged growth in revenues, earnings, cash flow, all else equal, will see their stock prices rise. But it's important when you're looking at growth stocks to separate the quote unquote secular growth from cyclical growth. Companies that are expanding on a secular basis are growing without regard to the overall business or economic cycle. In contrast, the fortunes of cyclical companies depend ultimately on where we are in the business cycle. For example, cyclical industries such as automakers, they can be showing rapid growth during periods of economic expansion, especially when the economy is emerging from a slowdown. However, as the economic cycle matures, their growth tends to revert back to the long-term average. Generally speaking, investors can spot cyclical growth stocks by observing when there's a spike in demand that causes a supply shortage, which then companies will ramp up their production to meet that supply shortage. However, this ultimately leads to a supply glut, which causes the rapid growth to collapse under its own weight. So the new growth letter that I'm working on looks for companies that are exhibiting strong defensive or secular growth. These companies have shown strong historical growth and are positioned to continue that growth without much assistance or resistance from the overall economic cycle. Now, I classify these as more sort of quote unquote true growth companies that are going to be expanding throughout the economic cycle. That's because they provide products or services that are in demand no matter where we are in the economy. So as a starting point, this new growth approach that I've been working on, it looks for companies that have shown growth, strong growth and cash flow generation that have been consistent throughout the economic cycle. These companies are seeing sales grow at a strong but sustainable pace and are generating positive operating and free cash flow that they can use to fuel future growth while maintaining strong balance sheets. Now, many deep value stocks exhibit qualities that make them questionable candidates for value investors. And this is also applicable when you're looking at growth stocks. Many growth stocks usually come with higher risk due to their expensive valuations as well as a potential weak financial condition. So when I've identified possible growth candidates for this new letter, I then switch and start using academic research to identify growth stocks with financial characteristics that should allow these companies to continue growing going forward, and thus will lead to higher stock prices. And for this, I used the G-score that was developed by academic researcher Partha Manohram. And he developed a financial indicator to help investors reduce the risk of growth stocks and find the best investment opportunities in the growth stock arena. The G-score is a financial indicator consisting of 8 criteria to evaluate growth stocks that separates the winners from the losers based on financial statement analysis. Monorham's research shows that investors can use this G-score to develop a simple growth investing strategy, buying high growth stocks and a high growth score that also then will have strong growth fundamentals. The G-score examines profitability, naive extrapolation, and accounting conservatism using popular ratios and basic financial statement data. So begin by looking at profitability. The G-score awards up to 3 points for profitability. You get 1 point for return on assets that are above the industry median, 1 point for a ratio of cash flow from operations to assets that are also above the industry median, as well as 1 point if the cash flow from operations exceeds net income. Monorham highlights academic research that indicates that ratio analysis benefits from industry comparisons. So I think this is one area that really differentiates from a lot of the other strategies that I've worked on over my 25 years. Is it really looks, almost across the board of most of these 8 points, is there's that comparison to the industry because a lot of ratios are very industry specific. The next component of the G-score looks at naive extrapolation. Too often, the market simply examines the path growth pattern of a company and expects it to continue going forward. As a result, two companies with the same historical growth might have the same valuation. But if you look at the trend of that growth, a company with more stable and predictable earnings and sales is more desirable and more likely to continue that growth. Monorham feels that earning stability may help distinguish between firms with solid prospects and firms that may be overvalued because of hyper glamour. Now, he measures earnings variability as the variance of a firm's return on assets over the last 5 years. And thus, a company is awarded 1 point if its variance in return on assets is below the industry median. The second growth signal in this category relates to the stability of year-over-year growth. Now, a firm with stable growth is less likely to disappoint in terms of future growth. Again, Monorham examines the stability of sales growth to help overcome issues such as negative earnings, which many high price to book value stocks, which was the basis of his quote unquote growth universe, may have. Sales growth may be more persistent and predictable than earnings growth because it's less subject to accounting judgments as well. Again, Monorham compares company variances year over year in their sales growth to its industry median, and companies with a lower variance than the industry median is again awarded 1 point. The final category for the G-score is accounting conservatism. And these three signals deal with a company's actions that might actually depress current earnings and book value currently, but in the future should result in greater growth and profitability. Monorham identified spending on R&D, research and development, capital expenditures or CapEx, and advertising as factors that may point to future sales and earnings expansion. Conservatism in accounting standards forces companies to expense outlays for many R&D and advertising efforts, even if they create valuable intangible assets that don't necessarily show up in a company's book value calculation. For these, a firm is awarded 1 point if its R&D intensity, its CapEx intensity, and its advertising intensity is higher than its industry median for these three respective things, these three respective metrics. And in each case, whether it be R&D spending, CapEx, or advertising, that's scaled to a company's assets. So you're not looking at absolute values. It's really how productive these are relative to the company's assets. So, I'm putting the finishing touches on the overall portfolio rules for this defensive growth service. I've been working very closely with the other analysts in John Bajkowski. I'm very excited about this. And in the coming months, we're going to be revealing more about this portfolio. But as John alluded to, ultimately this will join the stable of Platinum products and services.
That sounds very interesting. I know I've been following the G-score analytical process for some time, and it was kind of interesting looking at our testing of it as an approach, as a way to separating out the better growth, better, more sustainable growth companies versus the flash in the pans, I guess. I guess one of the things you also did, I know that's the service is still in development, is you actually went ahead, you've been applying the technique and looking at how to pick up certain stocks. And I think you actually have a company to discuss here with our audience.
Yes, actually, what I've discovered is, the G-score is an 8-point scale, and I'm really surprised actually how few companies actually pass on all 8 scales. So perhaps this is a unicorn, but one of the companies that currently have an 8 out of 8 on the G-score scale is ServiceNow, ticker NAW. ServiceNow is a software as a service or a SaaS model, and it's used this model to disrupt, take share, and in roughly 15 years emerge as the #1 information technology services management software company. ServiceNow definitely benefited from strong demand throughout COVID-19 as service and automation related solutions that it provides became critical for companies trying to do business in a new remote reality. We don't use ServiceNow, but even AAII, we definitely had to make the pivot rather quickly to remote working, and our staff pulled it off very, very well. But at the large enterprise level, this is where ServiceNow comes into play. Inevitably, hopefully as COVID-19 settles down, might not be as great a demand, but they've become so entrenched in a lot of these companies that these trends really should persist over the next couple of years, because I think a lot of companies are still trying to accelerate their digital transformation efforts. Really, along with a handful of other companies, ServiceNow has really become a key partner in digital transformation. And this is one of those secular trends that the growth letter tries to look at. These are sort of disruptive trends that aren't going to be sort of fad trends. These are things that will continue to perpetuate themselves, and the companies are really the leaders in these secular cycles and trends to be able to benefit from going forward. Just a couple of things that really stood out for me for ServiceNow is, they've become, again, as I mentioned, so entrenched in the enterprise software that, the company enjoys for its elite level customers, it enjoys retention of 97 to 98%. It's really become, it's an invaluable tools that they offer, but they also become so firmly enmeshed in the company that the switching costs are significantly high. So they enjoy a very high level of retention. Also, as they've expanded to more and more levels and have become sort of use the same model they did when they first launched, customers overall are re-upping for more than one solution. And more than 75% of its customers now are multi-product purchasers. And these are just driving deal sizes even higher and higher. So, its position as far as the IT world, it's then be able to take this expertise and convert it over to HR and customer service. Its product strength, its market presence, and its strong sales push into other areas outside of IT really should continue to drive that robust growth going forward. That again, inevitably there will be some slight economic and business cycle disruptions, but again, the importance of the services that ServiceNow offers really should buck any significant downtrend in the business or economic cycle going forward.
So Wayne, I know a lot of these high growth companies also traded high multiples. Do you have any concerns about that and in this particular investment approach?
Oh, absolutely. And it's because there is no valuation element to it. I will fully admit, full disclosure, I was very surprised. ServiceNow actually carries a PE currently, I think, of over 800. That is not, that's not a typo or a misspeak. But part of that is the company has been becoming increasingly more profitable over time. And that's what's really powered its PE so high currently. But I'm of the opinion, PE is a measure of the market's expectations. And when such a high PE stock, that could be indicative of the market having very high expectations for the stock, which is great. Expectations are great until you fail to achieve them. And especially for high-flying valuation stocks, when there is even that just slight quarterly miss, you often see very significant negative impact on share prices. But one of the things that's when we started developing this strategy is we want this to be not a buy and hold strategy, but these are companies that are exhibiting growth trends that hopefully will allow the growth to continue for several years. So hopefully these are stocks that we'll be buying for many years. So I'm the opinion valuations are definitely a measure of expectations for a stock, but I feel that the longer your holding period for a given stock, valuation becomes less important because next quarter ServiceNow might have an earnings miss and it might take a good haircut on share price. But 5 years from now, if these growth trends that are projected to continue, that slight miss in this one quarter isn't going to matter. So the longer your holding period is, I think valuations, especially being worried about very high valuations, really becomes less and less. So yes, be cognizant of the fact that some of these stocks will carry with them very high valuations, and that could lead to some short-term volatility. But if the trends that these, if they're true secular trends, these should continue going forward. So the high valuation, a few years down the line, really shouldn't mean much.
Thank you, Wayne. And members will, I'm sure, be hearing more about this as you flesh this particular service out. And if anybody who is a Platinum subscriber will automatically get it.
Absolutely.
And I'm going to actually ask, Charles to come back online here. I think, he has also found a stock that kind of really exemplifies how value, momentum, and quality intersect to come up with a interesting pick. Charles, why don't you take it away? And Jenna, if you could take us over to slide 28, I think.
Sure. And so while Wayne was firmly in the digital world with his pick, I'm going in the completely opposite direction with paper and packaging. So going over to the physical world here. But don't worry, this is not Dunder Mifflin. We're not going down Michael Scott level of operations here. Veritiv, as I said, it's a packaging corporation. They also do printing. A small segment of their business is actually tied to facility and office cleaning supplies, but it's a pretty minor segment. But they've been transitioning more and more towards doing containers, custom, I should say packaging, custom and standardized packaging solutions. It's a more profitable part of their business. But the other thing, and those of you who've been reading the AI Journal have seen me talk about the paper markets. And it really is a huge problem for us personally. As we talk, I actually got new samples of paper for the journal because the paper we're using is being discontinued. And so there's a lot of, I wouldn't say turmoil, but there's a lot of changes and a lot of things going on in the paper market, but it is driving up prices. And so if you're Veritiv and you're providing packaging, printing services, it allows you to raise prices. So they've been able to raise prices, expand their margins, boost their earnings, and all this has actually helped the stock price. And I know people think, oh, it's a packaging company. That's boring. It's exciting. It's done extremely well price-wise. Done great for the portfolio, but its fundamentals are extremely strong. The company's been a very avid been buying back and completed. It's been very avid in terms of buying back its stock, or I should say active. And recently completed a $100 million share repurchase program last year. This year they announced a brand new $200 million buyback program. And to put that in perspective, this is a company that has a market cap of about $200 billion. So it's a pretty sizable buyback, $2 billion. So pretty sizable buyback going for $200 million. Now, when you look at VMQ, so we actually assign grades and people ask about our value, quality, momentum grades. They're the same grades we use in A+ investors we do for VMQ. We actually started these grades with VMQ and we extended them to A+, but what you can see here when you look at the grades is that based on VMQ, the traits that we look for, Veritiv is a very attractive stock. Even though its price has done extremely well in the portfolio, it's done extremely well since we've held the stock in that portfolio. Its value grade is B. It ranks in the bottom quarter of all stocks. So its valuation relative to all other stocks ranks in the bottom 25%. So a true value stock. But at the same time, its price momentum, that's a momentum grade of A. And so if you consider all the stocks in our universe and you look on how they've done on a relative strength basis on a weighted 4-quarter basis, meaning we give the most emphasis in terms of price performance over the last quarter and 20% emphasis to how the stock's relative price strength rank has been over the previous 3 quarters, it's outperformed 97% of all stocks. So again, people think, oh, I need exciting, I need this price increase, I need this cutting edge company. Here's a company that comes across kind of boring by its description, but has outperformed most stocks. So it goes to show that when you use factors, you use quantitative strategies, such as I'm talking about for VMQ, such as Wayne just talked about in terms of growth, you do find these stocks that have characteristics you want, but might be in sectors you're not looking for. But I also just want to say this is a very fundamentally strong company. Its quality grade is A. Actually, its fundamental strength is better than 90% of all stocks when we look at quality. So this is a great example of why I really like screening and why I like quantitative strategies, because they find these companies that have these really great traits, in this case, value, momentum, and quality, but something or a stock that you might have overlooked just because someone said, oh, it's a packaging company. In every industry, you can usually find companies that are doing great things that have fantastic characteristics, but you have to be willing to step out of the sandbox of what you hear in Barron's, what you hear on CNBC, and really dig into it. And that's what we do with VMQ, and we certainly do with several other strategies here at AAII.
Moving beyond like individual stock selection, because obviously, you mentioned how in this case, Veritiv has been a big winner in your portfolio. Are there any lessons to be learned in how you manage a portfolio as far as not allowing a portfolio or a stock to dominate your particular holdings?
Yeah, and that's a great question. So Veritiv qualifies for a purchase, meaning it meets the buy rules of the VMQ portfolio. But it's done so well that it actually got too big of a position in our VMQ portfolio. So for the model portfolio, just to back up, our goal is to have an equal weighted allocation when we purchase a stock, meaning it's a 20 stock portfolio. We take the total value of that portfolio, divide by 20, and that's the amount we actually want to invest in a new stock. Now, so the target weight for each stock when we add it is 5% of the portfolio weight. 5 times 20 equals 100%. Veritiv's portfolio weighting actually went up to about 13% of the overall portfolio. So it was that stock alone was having a very large influence on the portfolio's return. So we wanted to bring it back to maintain that spirit of having equal weighting. So I actually reduced the stock. I took some profits. So the stock's weighting is now down to about 7% of the total portfolio. And so it's an arbitrary rule. There isn't this hard and fast rule where you look at your portfolio and say the stocks will reach X level, I need to pare it down. But to give people some guidance, we actually, for VMQ, we actually use a measure of 2.5 times the average position. So in this case, if the average stock in the portfolio is supposed to have a 5% weighting, and Veritiv's weighting was over 12.5%, 2.5 times 5% equals 12.5%. That was our benchmark for let's take some money off the table and reinvest in other stocks. So this is really not anything wrong to do with Veritiv. In fact, this is a wonderful problem to have, but it really is an allocation strategy we use to keep one stock from dominating the portfolio's performance.
And I think it's important to look beyond even one stock. It's important to look at the industries of the stocks in your portfolio and the cap size. I know we're going to bring Matt back here now. And we actually, I remember once in the shadow stock portfolio, I think we had a great positive run on bank stocks based in Puerto Rico. Now, again, they had a great run, but to have such high concentration, not only in the financial industry, but in a certain region of the country, obviously brings up a lot of risk. So thank you very much, Charles, and you'll be around for questions and answers later, I assume.
I certainly will.
And so Matt, I think, is going to use a NEF approach stock to help illustrate a interesting idea as far as investing is concerned. So if Jenna, you could advance us over to the slide 31, and Matt, take it away.
Thanks, John. So the NEF approach is ultimately looking for high value stocks, and this company, Jabil Incorporated, the ticker JBL, is a technology company, and we've seen in the past few years technology companies have become extremely overvalued, and you go, okay, well, isn't it time to move away from technology companies? Well, looking at this company, that's not the case. So they're an electronics manufacturer. They operate in two specific segments they call EMS and DMS. These are electronics manufacturing services and diversified services. So the company is, they provide services to the majority of anything you can think of technology subsectors. Now this is going from automotive sectors to computing, to industrial, to even emerging sectors such as electronic vehicles or electric vehicles and 5G coverage. Now, the thing that makes this company interesting is that a lot of technology companies tend to stick to a product line and they continue to improve it and improve sales in that line. Now, this company is doing something a little different by pushing to diversify their position in every single one of these industries. So first off, the company has the two segments and uses their prior products, such as computer chips, let's say, and now they're developing products for, I think it's eco-friendly packaging, which you would think that's not technology. Well, Jabil is working towards improving their margins across every single industry. It's a different approach than to improving sales. Specifically, they are working towards improving sales across the board. Now, we also talked about, or I'd also talked about previously, that the NEF approach looks primarily at the dividend adjusted PEG ratio, and Jabil currently has a dividend adjusted PEG ratio of 0.8, which suggests that the company is undervalued in the eyes of the market. Basically, their expected growth is higher than what the market sees the company is valued at. Their current PE, or their valuation, is 10.5 compared to last year's PE of 22.1. That current PE is also much farther below the industry median of 15.1. And contributing to their growth is an 11% average annual sales growth. And the company, as I said, is moving towards improving their profit margins. This is going to be improved across all of their products and services for each one of their segments. And the last and possibly most crucial thing to look at for the NEF approach is their ability to reinvest in their business. And this is a measure of their free cash flow generated by the business. So over the last, go ahead.
Sorry, go ahead. No, you're fine.
Over the last fiscal year, the company generated an increase by 40% in free cash flow. And also they announced a $1 billion stock buyback program that to be carried out over the next year. Now, mind you, this is a $8 billion market cap company, so they are seriously pushing for huge growth within each of their segments and improving profit margins versus just improving the amount of sales.
One of the things I always like to do when I'm investing in a company, and I know you're of a similar bend, is you like to look ahead and pull up the 10K and 10Q and look at some of the risks that are involved there. Are there any concentration risks involved with this company? Do they have any big customers that might be a concern at all as far as going forward?
So yes, with a lot of technology companies, they like to have suppliers, or I guess they're the supplier, but the Jabil Inc. currently has around 30% of the revenue allocated towards Apple and Amazon, being their primary purchasers of their products. So if they lose one of these customers, it's going to be a huge impact on their future sales growth. But I mean, they have been.
But you also want to have growth, right? So you want to be selling to those big companies too.
Yeah. I mean, this happens with a lot of companies. They tend to, especially with these bigger technology companies like Apple and Amazon, who purchase a lot of products from smaller companies. And you would think that that trend is going to continue and their growth would.
Well, the NEP approach sounds very interesting. I like how it uses the growth at a reasonable price, the GARP element with the PEG ratio, as far as narrowing down its choices, and also that's then used on the sell side as well. When you don't have that growth, when no longer attractively priced, that's how you go ahead and then prune the holdings. And so thank you very much for presenting that. And I know Derek, you're kind of running a little bit short on time here, but Derek, I know you've got a stock here that really illustrates the 3 pillars approach to investing. Why don't you tell us a little bit about your selection here?
Absolutely, and I'll try to go through it relatively quickly. I think we've talked about, if we go back one slide, Jenna. Yep, right there. There we go. That's the one. So I mean, the dividend investing stock pick that I'd like to discuss today, it's called Huntington Ingalls Industries. The ticker is HII. The company is the largest independent military shipbuilder for the U.S. Navy and Coast Guard. And really the investment thesis here is demand for U.S. Navy shipbuilding and services is primarily driven by growth in the U.S. Defense Department budget, which is rising, especially given the situation in Ukraine. The company is also positioned for steady long-term growth. It has their backlog is just incredible. It's robust. It's 48.5 million, and that's as of December 31st. So that's about 5 to 6 years out. They have business that will continue to grow. So, and at DI, we use a proprietary quantitative strategy, a rules-based strategy, if you will, with over 40 different characteristics, which we combine with the 3 pillars of dividend investing, which we talked about earlier. And we do that to identify stocks that have the potential to rise in price and make larger dividend payments in the future. And I think Huntington Ingalls is exactly one of these candidates that fits that strategy. You can see on the screen a few of the select DI screening characteristics we use and how HII does or doesn't meet the quant filters. It has an attractive valuation with its current yield above its 5-year average yield. It has increased its dividend for 9 consecutive years, which is a huge indicator for the DI portfolio. And its 5-year dividend growth rate is 17%. So a lot of great characteristics that make this a good fit for the DI portfolio. What we don't like to see, you see in one of the select DI screening characteristics, we don't like to see that the 5-year EPS growth is less than 3%. But really, this is more of a recent change in the last few quarters due to some labor and supply chain issues, which a lot of companies are experiencing, especially recently, and inflation, et cetera. And one of the key risks for HII is accurately estimating costs and the time for shipbuilders as shipbuilding becomes more difficult as modern warships grow in complexity. And really just for the sake of time, I'll just stop there. You can see how it meets a lot of the characteristics that we look for the DI portfolio.
Thank you, Derek. And I guess like any kind of stock, there are other risks. I mean, there's government funding. There's how the purses of the taxpayer will be spent. But I think it's funny given given the certain change, I think, in the overall world global impact with the rise of the Russian invasion of the Ukraine. I think even some of the tension with China. I'm guessing there's going to be demand for their products going forward, and it seems like whether you have a Republican or Democrat at the helm, we're probably going to have demand for their products going forward.
Yeah, I would agree with that.
Thank you. With that, let's bring back Wayne. Wayne's going to give us a quick overview for what the overall, kind of wrap up the overall Platinum package, what it has to offer. Tell us a little bit about special reports that are available, and then we'll open the floor to questions. Go ahead, Wayne.
Sure. Jenna, actually, if you could skip to slide 36, please. So, since its inception in 1978, AAI's core mission has been to offer unbiased, straightforward, and actionable investor education to individual investors. In addition to help investors who are looking for curated stock ideas, as we've been talking about, for the last hour plus, we have a number of model portfolios hired at the association, including our model shadow stock portfolio that didn't get a lot of discussion today. But we also offer tools and services to satisfy the evolving needs of do-it-yourself investors. To that end, we offer data products such as AAI Stock Investor Pro, Fundamental Stock Screening and Research Database Program, as well as our A+ Investor Service, which we launched in 2019. So we have membership, our portfolios, and our data. But and John alluded to this in the intro, really to offer sort of a complete wealth system for individual investors, we now offer our Platinum service, which you can see on slide 37, everything you give access to. AAII Platinum combines unbiased investor education, online stock, mutual fund, and ETF investment discovery, analysis and tracking tools. I apologize.
Is that Polly behind you there giving us a little bit of extra color?
And Fiona is chasing her, so we might have some excitement in a moment.
This is the joys of working from home. Sometimes your pets come in and they disrupt your life and they make your life a lot of fun as well. So thank you, Wayne, for continuing.
But yeah, the Platinum combines unbiased investor education, online stock, mutual fund, and ETF investment discovery, analysis, and tracking tools, as well as market-beating model stock portfolios, and really combines that, ultimately into one. We've talked a lot about today our different model portfolios, but another aspect of Platinum is our A+ service, which is an online, basically analysis and tracking tool. And the packet that you can download from this presentation really dives a little bit deeper into A+. But really, when we launched A+, it was to help, what tools can we provide to help investors solve the problems that they face. So it offers investment discovery, stocks, mutual funds, ETFs, portfolio tracking, allows you to see whether or not you have a diversified portfolio. And ultimately, it's an AI providing an independent source of data and information. But again, for the sake of time, you can find out more about the A+ service in the handout that you can download from our website. And to that end, too, if we can advance to slide 41. Ultimately, one of the benefits of attending today's webinar is we have our AAII Platinum special report. And in this, you can get more information on, 4 of the 5 stocks that we were talking about today. We're still in the development stages of the new growth letter, but 4 premium picks, actually 3 talked about today. So the picks from DI, SSR, and VMQ, as well as a pick from our shadow stock portfolio. But that's sort of a thank you for everyone who has attended today. And so with that, do I throw it back to John or to Jenna?
We'll just answer questions if you don't mind.
Okay.
In fact, Jenna, you can throw it forward one slide. And Wayne, why don't you answer this first question? I think a member had here. What is the fee for the Platinum service?
The Platinum service, actually, if you sign up right now, we're offering a special offer for $499 for regular AA members. But if you've committed to us as a lifetime member, we as our thank you for being a lifetime member, it's $399 a year for Platinum.
And you could check on this, but I've got a comment here from Kathy Starr that our handout does not match the slide deck. So if that's the case, we'll be sure to repost it. So I'm sorry about that. To the best of my knowledge, it should have been the same, but we'll be sure to tomorrow. Anybody who signed up for the webinar will have an email that goes out to them tomorrow with a link to the download. And in case there's any kind of mismatch, we'll be sure to correct that. Sorry about that situation. In terms of, perhaps Emma who wants to handle this question here. What are the explanations of value, quality, momentum in the VMQ program? Are they more detailed or different than what they are with the A+ investor?
Yes, they are. Actually, that has been on to do for a while. The underlying calculations are exactly the same, but yes, I do believe you probably get a little more in-depth explanation of the underlying components of value, momentum, and quality on the VMQ site versus A+. But the underlying calculations themselves and the underlying component metrics are the same between A+ and VMQ.
And this is, I guess, more of a technical question here about the service. So if someone is subscribed already to a couple of these, let's say they're a SSR subscriber and a DI subscriber, and they choose to become a Platinum subscriber, is there any adjustment made to the pricing of the service?
There is a proration. Our member service department can assist with that. But yes, if you currently subscribe to any whether A+, DI, SSR, or VMQ, and decide to upgrade to Platinum, there is a proration that we do offer.
Thank you. So Derek here, do any of the recommendations that we typically put on here move the market?
Not in the case of the dividend investing portfolio. Like I mentioned, we do have more of a tilt towards mid to large cap stocks, and really, we do have a large base of members for the DI portfolio, but the market caps of these companies are so large that really, when we make a buy or sell recommendation, you don't see it in the market, unlike what could happen with the shadow stock portfolio, which are more thinly traded, smaller market caps, and you can really see some movement from buy or sell alerts, but not for the DI portfolio.
Probably the one with the smallest size holdings is perhaps the VMQ service. I think there's been some overlap occasionally between the shadow and the VMQ picks. Is that fair, Charles?
That is fair, because VMQ, we actually start about $30 million as a minimum market cap, which is the same as a shadow stock portfolio. And then we'd be willing to consider Apple if it qualified. So a big range, but yeah, there can be occasionally overlap. We try to limit overlap between any of our portfolios, but sometimes it just happens.
And Ellie here, this is probably going to be for Derek. Ellie here notes that one of the benefits of investing in dividend paying stocks is you get to reinvest that income and grow your portfolio. Wanted to make sure that the information that's presented within DI and within your analysis actually includes the reinvestment of dividends.
It does. No, it's a great question. No, we're big believers in the compounding effect and the reinvestment of dividends. So like I mentioned, we do, based on the current portfolio composition, we do receive dividends on a monthly basis, and when that becomes a large enough amount, usually over $1,000, we will start to reinvest in companies in the portfolio. That the first thing we look at is if it's still passing the quantitative filters, and we also look at if it's underweighted compared to the other holdings in the portfolio. But that's a good question. Big believers in reinvestment of dividends.
And someone here was wondering, with I think it's Jim here, with the increasing rate of inflation. We saw a pretty big inflation number come up just the other day, and rising interest rates. How do these strategies, how are they going to interact? How are they going to respond to an environment that is consisting of higher rates of inflation, higher rates of interest rate? Any thoughts? I know we've covered that as editors. You guys have covered that, so feel free to jump in and take that question, any one of you.
Maybe
I'll
more
go
so. I
first.
mean,
Okay.
no, I've spoken enough, Charles. Please go ahead.
Well, it's always, we can never have enough, Wayne. But I just want to say one of the things with our strategies, so our strategies are all quantitatively based. And so those strategies adjust based on what's going on in the market. So for instance, I recently added Silverbow, which is actually a oil and gas exploration company, particularly natural gas. And when I looked at VMQ, what was meeting criteria, I saw oil companies, I saw steel companies, commodity-based companies, because those stock prices have been bid up. So one of the ways our strategies adjust is not us trying to say, oh, there's inflation, let's do this. The quantitative strategies actually adjust to what companies are currently meeting the criteria. And as conditions change, so do the companies that meet our criteria.
And just to confirm, I'm sorry.
Well, I was just going to add for specific to the DI portfolio, the types of companies that we have, they are leaders in their industry. They do have pricing power, and one of the characteristics we are looking at is what is the 5-year average growth rate. For Huntington Ingalls, it was 17%. So I mean, that's the great thing about dividend paying stocks is that you do have that dividend growth element that can cover some of this inflation.
And here's a question, I think, for Wayne. Sorry, Matt, I know there's got to be questions here for you as well. There's stuff to come up, so sorry about this. But growth stocks are usually a lot more volatile. How do you explain? I expect to update the growth portfolio. Do you think it's going to be, quarterly? Is it going to be? How often are you going to look at changing your holdings? Do you have any sense on that?
I mean, my inclination currently is probably to, lean more towards the monthly model that we follow for like SSR and DI. There's still a lot of things we're trying to flesh out. Is this going to be more of a pure ideas portfolio, or is it going to be sort of a real money model portfolio like we do for VMQ, SSR, and DI? So if it's more, well, irrespective if it's ideas or whatnot, again, ideally these are stocks we're going to have longer holding periods, but it's still, at least providing information or updates on the portfolio. Probably realistically, follow the weekly commentary model that we use for other portfolios, and then probably a monthly review. Because yes, I mean, they can be more volatile, but at the same point in time, it's that, you hate to see a stock drop 20 or 30% in a given month, but what's driving that stock decline? If it's an overall decline in the market, then rising tide rises all boats, falling tide lowers all boats. So it comes down to just because the stock price is highly volatile, what's the underlying fundamentals of the company? So I would assume we probably would adhere to some type of probably a monthly portfolio review process for this new letter.
And Charles, perhaps this will help explain how the VMQ process works. But obviously, when one seeks to find just high growth stocks or just momentum stocks or just value stocks, whatever you are, you're kind of swinging for the fences. When you kind of do a combined approach, we try to mix up value, momentum, and quality, or anything like that. You're perhaps not swinging for the fences quite as much, but trying to hit doubles and singles. So when is there a risk of over-reliance in VMQ if an investor primarily relies on investing in only those stocks with an average score of 85 or 90 for the 3 different factors that make up VMQ? Is that probably not a correct statement there, right?
Yeah, no, I think I understand what the member's saying, though. There is always a risk anytime you go with a specific strategy, whether you're going, in the case of VMQ, value, momentum, quality, or if you're going for growth or you're going for dividends, there's always a risk certain things are going to be out of style. We recently went through a bad value drought, particularly in the latter half of the last decade, where the underperformance of value was really dragging down this combined approach. But I think that's where it helps to look at the long-term, what's worked, what characteristics have worked. Otherwise, you get in a thing where you're really into a scenario where you're trying to time the market and you're trying to guess, okay, is growth going to be in style right now? Is large cap going to be in style right now? Is, are dividends or buybacks going to be in style? And you try to play that game. And yeah, if you hit it right, you have some good returns, but then you may not know where the turning point's going to shift. So that's why I prefer actually sticking with a strategy that's based on what's worked well for the long term. And when there are periods where it's a little bit out of favor, just sticking with it, because there is that risk of short-term outperformance that also contributes to long-term outperformance, because there is that history and there is that compensation for, yes, you're following the strategy, but you realize there might be periods over the short term where you might grit your teeth a little bit.
And Matt, the SSR approach relies on 4 gurus to help come up with some quantitative models to determine the portfolio management rules. Do you anticipate those gurus changing over time, or you think you're pretty much locked in? You've picked some really solid guys. You think that they're going to be there for the long term?
Well, I think that there's plenty of gurus out there over the years, and right now I think what we need to look at is which works and which ones work together. So you don't want to have 2 gurus who invest very similarly in the portfolio, and I think that currently the 4 strategies are diversified enough so that it works together in a good sense. But I think that in the future, there is potential for looking at new strategies and adding new strategies, and may not even deleting old strategies, just keep growing.
I think I've heard it said more than once. If the facts change, do you change your opinion? And definitely, I think if you're an educated person, you change your opinion. So
yeah. It's also worth pointing out. It's also worth pointing out, the 4 strategies the SSR follows. 2 of them still are the NEF and the Cancelim screen have been followed since inception. And the Drummond approach is from 2006. And the O'Shaughnessy is relatively new. We've been following that for a little over a year now. But it has to be a pretty long period of underperformance before we do shift.
Well, I want to thank everybody for listening to us. It's obviously you guys did a great job of explaining your viewpoints of your various strategies. Any closing words? Anybody want to any thoughts before we hand the seminar or webinar back over to Jenna?
I think just generally speaking, it doesn't matter if you're if you're a growth investor, a value investor, an income dividend investor. I think at the end of the day, whatever type of investor you are, success really rides on having a plan that you believe in and have the discipline to follow.
I was going to echo what Wayne says. I have a saying around the office called trust the strategy. And if you have a strategy, that's evidence-based, that you know the evidence behind it shows it's going to work, then as Wayne said, it really comes down to discipline, just sticking to that strategy and realizing the strategy is going to be less emotional and more rational than your brain ever will be. And so for investing, knowledge only gets you so far, but discipline gets you really well over the finish line and onto the podium where you can receive your medals.
Thank you. Well, hearing nothing else, I'm going to let Derek finish us off with his famous saying.
Well, thanks for joining us today, and we're all wishing you green arrows. Thanks for that,
very
John.
much.
Take care, everybody.
Appreciate that. Thank you, Jenna. It's all yours.
Awesome. Thank you so much. Well, we're just going to wrap up with some upcoming webinars that I want to showcase. Oh, sorry about that. So we have the Individual Investor Show on April 21st at 4:30 p.m. Central. It's called The Emotional Psychology and Behavior Behind Investing. And I actually get to talk, we get to talk to Spencer Jacob about his new book, the revolution that wasn't, GameStop, Reddit, and the fleecing of small investors. And we discussed in this interview the phenomenon of meme stocks. We also sit down with Charles Rapplett to discuss his newest article in the April 2022 issue of the AAII Journal. What traits do individual investors consider when buying stocks? And to catch the newest release of the Individual Investor Show, you can subscribe to us on YouTube, as well as one of your favorite podcast platforms. We're on Spotify, Amazon Music, Audible, Apple Podcasts, and so much more. And to view and register for upcoming webinars, just like the one that you watched today, you can visit aaii.com/webinars. And before we wrap up, I'd like our webinar, I'd like to take a moment to thank our sponsor, Discover Bank, with a really quick video.
And now for a message from our friends at Discover Bank. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner Discover Bank on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part, all of the deposit accounts offer preferred member rates. Take a look. With Discover, you can earn over 5 times more interest than the national savings average with preferred member rates and pay no fees. That's no fees, period. Plus, no minimum balance is required. You can access your AAII member savings account with Discover Bank from your smartphone or tablet, so it's easy to keep your money moving in the right direction. Open an AAII online savings account to start saving for the future today. Visit aaii.discoverbank.com to learn more.
And I wanted to cover really quick that through Discover Bank, AAI members have the opportunity to save with high yield DDs, savings and money market accounts, as well as IRA CDs. And AAI members receive preferred member rates on all of Discover Bank products, no matter what subscription or status of AAI membership you have. And I just want to say a big thank you to all of our financial analysts for highlighting AAII's premium products, as well as their top stock picks from each service. And to mention again that this presentation was recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with all the links to the presentation handouts and any resources that we discussed. And with that, we wish all of you viewing good health, good fortune, and a great afternoon. Take care.